What is up, YouTube? This is the Working Investor. It's that time of month again, the time of the month that we talk about the goal. I started off my goal earlier in the year in March to make $1,000 a month. And at that point, it was just doing selling options and making option premium. I transitioned to 0-day to 70 to expiration options back in June. And eventually I transitioned in July slowly into the high yield dividend space. And in September, I pretty much completely in the high yield dividend space. October, I started using margin. And my goal initially was to hit $1,000 a month. And then eventually it was to hit $3,000 a month by New Year's. So we'll start off with this video talking about what I've earned this month, in this past month in December, what my goals are coming forward, what are some changes in the portfolio. Let's get into the video. So for December, hit $9,779.98. Almost hit the $10,000 mark. So that puts me for the year $32,642.33. I'm going to have to pay tax on that, on most of it. And that makes my monthly average $32.64. So let's see how the portfolio is structured. So currently I have accrued 5,100 shares of YMAX, 500 shares of AIPI, 500 shares of RDTE, 1,000 shares of NVDY, 1,000 shares of TSLY, 1,000 shares of MSTY. I'm starting off with 100 shares of FEAT, and I have 100 shares of XPAY. The bottom two are kind of experimental, and we'll see if I may keep them or get rid of them. So I pretty much, if you see, most of my equity is in a, rounded, diversified fund of YMAX. They do have their own inherent risks with YMAX. I have some videos where I talk about it. I may make some more videos on it. I'm comfortable with this risk to reward. I have AIPI, which is rec shares. So it's a different fund that also do cover call. They actually own the underlying. And then I'm diversified into another company called Roundhill, which is RDTE. And then XPAY is also Roundhill. And then I do take on single stock exposure with NVDY, TSLY, MSTY. And I am taking on single stock risk in these underlying. I'm not planning to actually build them up for now. But the reason why I take on the single stock risk is because they do have, a pretty good reward for the risk that I'm taking on with single stock, in my opinion. And then FEAT, I understand that FEAT is a fund, which I made many videos on FEAT and 5e from YMAX, which I understand it right now it doubles up the risk because FEAT, 1/5 of FEAT is TSLY currently, and 1/5 of FEAT is MSTY. So I understand that I'm doubled up in the TSLY MSTY with the FEAT. I'm going to see how it performs. The fund is under 30 days old. And I may build this up to about 500 shares. I don't intend to try to build up more than that unless it really goes down in price and I have a good opportunity. I'm kind of, I'm taking my time and no rush. If I see something else, I may continue on further on something else. And then this XPAY. So the reason why I got into XPAY is because I found a use case for it. I did make a video kind of unsure what the use case is because it seems like what they do is they take your money and they put it in the S&P 500. They buy deep in the money, long calls, leaps. I'm talking like, one penny. So, the S&P 500 has to go below 1 penny, which means the S&P 500 is pretty much dead in the water. And that means that it's the end of the world. So I don't think it's ever going to go, if it goes below a penny, then we are in we have other things to worry about. They do take about 49 basis points, and they just basically just pay you they target 20% return consistently. So the reason why I have it is because if you look at my portfolio is the cover call strategy. Almost all of them are, cover calls, synthetic cover calls, and they do sometimes call credit spreads. But if you notice that there is always a capped upside. So I like to have some of my portfolio sitting uncapped. So here I can park my cash uncapped, and the market is going down, of course. And the thing is, if the market does rally, at least a portion of my portfolio has uncapped potential. I am taking on market risk, and there is a risk of sequence of return. So that's something which I don't like too much about it. In basic English, sequence of return means that if you're, because they pay 20%, right? So they target 20% return. If you divide it by 12 months of the year, they're paying you about 1.66% per month. But when you normally have and they try to do everything as return on capital, which I'm not a tax advisor, financial advisor. This is just for fun entertainment purposes. Do not follow me. See all my disclaimers. I'm just sharing you with my journey. But, they give you 1.66%. But what if the market's down, right? If the market would be down, normally I would not want to sell my assets on the dip. I'd rather sell them on the when they pop up, right? But this thing will just continuously just pay you back the funds when the market is, whether it's up or down or sideways. So there is a risk over there. So I understand that risk, but I'm gambling when I buy this fund. My mentality is I'm gambling that the S&P 500, let's say out of 12 months of the year, maybe it'll be down 2 or 3, maybe even 4 months of the year. And I'm gambling that maybe the 8 months of the year it may go up. So therefore I'm betting that the net asset value will stay relatively stable, and I'm parking my cash in the S&P 500. I do take on market risk 100%, but then I get to have my funds. I'm kind of like having the cash come back to me and have it in a tax efficient way. And I actually got an email with their distributions. I'll show you a picture of it. So you can see Roundhill sent me this email the other day. Pretty much you could see it looks like they pay every single second Thursday of the month. That's why you see the 9/13. If you look at every month, look at the second Thursday of the month. It seems like that's the pay date, more or less, the second Thursday of the month. And you see here consistently, this is what they sent me in the email, consistent about 95 cents per payment. So again, this is not money that deriving from, call credit spreads like, other funds do, like GIAX, or QQQT or SPY-T. They do call credit spreads. They don't do like, 0 day to expiration, cover call, synthetic cover call like TSLY or XDTE does, but they pretty much are just giving you return on capital. So I'm looking at it like a way to park my cash in the S&P 500, and it kind of forces me to take, it's like selling a little portion of your S&P 500, and it wouldn't even, instead of long-term capital gains, they're considering it 100% return on capital, which is interesting. Again, I'll have to figure out, I got to talk to an accountant and see more into this. So it's just a cash. I'm testing it out. I may just get rid of it. We'll see. I'm just kind of testing it out for now. So instead of, I have dividend trackers all telling me, different dividend trackers telling me it's going to hit about 10,000 a month, the track that I'm on. So, but instead of that, I also kind of plotted out with, how much equity I have and then percent target that I would probably get, like AIPI about 34.8% annual return, annual yield, RDTE about 35, maybe off a little bit, YMAX 0.6, could be 0.5, 0.6. I'm just going to put NVDY 0.75, MSTY 1, even though MSTY is probably a little higher than 1 historically, and TSLY 0.6. So I figured, if NVIDIA or TSLY is a little overly bloated, then, MSTY will kind of balance it out. So hopefully get close to real numbers. XPAY was easy. I just put 0.2. That's the dividend target. FEAT, I'm going to put 0.7. Just my guesstimate. We're going to have real numbers soon. So this is where I am now. So according to, my data, looks like I should be somewhere in the $10,000 range. And if you guys notice, I pretty much have zero ULTY. I got completely out of ULTY. Like I mentioned in my other video, and I'll put a link to it. I really want to love this fund, and I probably may go back into it if it proves itself a little bit better. I feel more comfortable parking my cash personally, my personal journey, my personal risk tolerance in YMAX for now. Doesn't mean I'm all anti-ULTY. I don't think anyone is foolish for investing ULTY. It's your personal choice, your personal opinion. For me, it's not, it keeps me up at night just thinking about how low it's going to go, because I've seen this fund go down, whether the market is bullish or, we're in a bull market, bear market, sideways market. One thing I could tell you, overall, month over month, ULTY has been going down. The rate of of it going down has definitely gotten better. It did not as much, but it's just something that I'm not comfortable with right now. It reminds me a lot about IWMY and those defiance funds that kept going down a lot. Some people like it, some people don't. I'm not, just my personal style that it doesn't fit with my style for now. But I'll keep an eye on it. But that's a big thing. Anyways, I also have another way of looking at it through shares. Looking at it just through shares, it looks like I should be somewhere around $9,676. But my goal is to eventually get FEAT to, approximately 500 shares. So if I hit that goal, that's 800, 500 shares, I should be a little bit into the $10,000 range. So that's kind of how I'm calculating. Of course, you can use the, dividend trackers. The reason why I like to look at it through equity and through also, dividend amount, because certain dividends are very stable. Like, the XPAY, they pretty much just give you the whole year in one shot. AIPI is also really stable. They always pay. They've historically, again, nothing, past performance not indicative of future gains, but they've historically been very consistent with about $1.40 to $1.50 range, somewhere in that ballpark. So I kind of put $1.45 because it's very, very consistent. But sometimes I like to look at equity, because if there's some funds, let's say target, let's say a 30-40%. So it's a 30-40% relative to the price of your stock. So that's why I sometimes like to look at it via the equity lens, and sometimes like to look at it via the amount of share lens. That kind of give me like two different models to kind of give me a clearer picture. Of course, applied volatility can change. There could be different seasons of implied volatility that definitely changes if you a lot of your funds are option based. So a lot of other factors, but it kind of gives me, a ballpark of where I'm at. So the question is, what is my goal for 2025? So right now my goal is to try to be consistent and get to $10,000 every single month in dividends. Try to find funds that kind of stay either range bound or grow. But even if they kind of go down with the market, I accept the market risk. Markets go up, markets go down. If I can't stomach that, then I shouldn't be in any of these funds. That's my opinion. But as long as some funds show that they have some promise to kind of stay within a range and they have some recovery potential, I'm okay stomaching, that roller coaster ride. Because if the roller coaster can go down, it can still go up at least a nice amount. I could kind of stomach that ride. So that's where I am right now. So I'm trying to find a good risk-adjusted return for 10K a month, and then we'll see where the year goes and how it progresses. Hope you guys enjoy. Let me know how your journey is going. Again, nothing here is financial advice. Look at all my disclaimers. Hope you guys have a wonderful trading day.